Thanks for coming on the show, Eleanor. Let's get straight to it then. Your initial reaction to this concern, this anxiety around the inversion of the curve and what that could tell us of what to expect going forward in terms of economic growth.
Well, I think it's important to note that typically following a yield curve inversion, the economy will on average peak around 16 months later, and the equity market as well will peak around 5 months before us. So really the longevity of that time frame maybe isn't particularly useful for investors right now. And I think what we're seeing at the moment is that we really need to see a more persistent inversion of the yield curve and of greater magnitude as well. I think we need to see that yield curve inversion ticking up to maybe around 15 to 25 basis points and persisting for potentially around a quarter before we sound the alarm signal that a recession is imminent and inevitable. So I think for investors looking at the yield curve now, it's more of a flashing amber alert signal rather than an overt alarm signal.
The folks at Richardson GMP make the point that last time around the curve inverted, you saw a rally in U.S. stocks to the tune of 26%. That's back in 2006. Is that something that you've crafted out as well for a possible scenario that this is sort of the last hurrah and might as well just join the party until the very end?
Well, I think it certainly could play out that way, but I think that we've seen global equity markets come so far off those December lows that we're now looking at a situation where a lot of that accommodative monetary policy is priced into global markets now, those central bank U-turns, and as well the optimism on trade, which so far has not prevailed as we have not seen this trade deal come to light yet. And a lot of that has really been priced in and has been the precipitation for the rally that we've seen since December lows. And I think we've really reached a point where we've potentially come too far with that. And I think potentially the reaction that we saw in markets last week to the Federal Reserve's latest dovish turn really cemented that fact. And we're now entering a new paradigm in this next quarter whereby maybe bad news will actually be bad news again rather than being good news, as we do have a lot of this accommodative monetary policy priced in. And that means that as the data continues to deteriorate and fundamentals continue to deteriorate, the equity markets won't continue to ignore that and will sit up and take alert. And that means that we probably can't avoid a correction in the near term for equity markets.